What's up, traders? Today I just want to make a quick video about one of my favorite trading strategies. The strategy is called the PKC. It's a 3-bar reversal pattern. It's for beginners and advanced traders. If you're a beginner, this video is perfect for you because I will detail a step-by-step process on how to find and execute the setup. If you're an advanced trader, you can also use this to supplement your trading. You can use your own entry techniques and just be aware of the potential reversal once the setup happens. If this interests you, then please watch the video until the end because I have a lot of sauce to share. But first, let's get this out of the way. Disclaimer: information provided in this video is for informational purposes only. It should not be considered financial advice. Buying and selling financial instruments is highly speculative and carries risk. In other words, this is not financial advice. Alright, so let's get into it. So what is the PKC? The PKC is a 3-bar candlestick reversal pattern that forms at key support and resistance levels across all time frames. So key here is it happens at key levels where traders are expected to buy and are expected to sell. And it happens across all time frames: weekly, daily, monthly, 3 months, yearly, you name it. 1 minute chart, 3 minute, 5 minute, and 15. It happens across all time frames. When it occurs, it creates very strong supply and demand zones that when price retraces back into it, it almost often leads to a strong reversal. The important thing here is it allows you to plan your trades from afar, set alerts with clear and defined risks. So basically, once you see the pattern on the chart, you can pretty much plan your trade. You can set alerts on the PKC and pretty much just wait. So when you trade it and it fails, it also creates a failed PKC. That is also a reversal strategy in its own, and that I'll probably explain in future videos. So this pattern occurs in forex, stocks, and futures. So it is a strategy that probably works for all asset classes. The reason why the strategy works for all asset classes is because it involves buying and selling, which happens every time. There's always a candle that will buy and sell, and there's always a candle that gets trapped once one side wins. So once you're able to determine that this is a PKC, then it creates a very strong supply and demand zone that you can pretty much trade. So here is the PKC on the 3-month time frame. It's set up here, pretty much did a rounded retest, wicked into it, then finally collapsed after. 1 month time frame, it's set up here, rallied, then pulled back into it, then did a perfect retest of the mid-range, closed above it, then retested the top, then rallied. 1 week time frame, it's set up here, pretty much rallied, did a double top, pulled back into it, touched the base, touched the top, then did like a 20% rally. Daily time frame, it's set up here, rallied, broke market structure here, did a rounded retest, tested the mid-range, rallied, tested the mid-range again, did another rally, broke market structure here, then was the bottom 4, and rallied like, I think that's 100%. H4 time frame, it's set up here, did an impulse, rounded retest, touched the top, rallied, touched the top again, then rallied. H1 time frame, set up here, rally, did a rounded retest, tested the mid-range, rallied, tested the top, then rallied. M15 time frame set up here, did a rounded retest here, only tested the top, couldn't even reach the mid-range, and pretty much rallied from there. So as you can see, the PKC happens across all time frames, and once you get a really good PKC at a key support or resistance level, then the reversal is usually pretty strong. Okay, so I just wanted to do a couple key reminders of the PKC. So the buying and selling of the first candle always happen at key support and resistance levels, as well as high time frame supply and demand zones. So if you just did basic supply and demand, just marking it up, sometimes if you notice, if you go back on your charts, sometimes you'll see the PKC happen or PKC occur. Also, if you have like swing highs and lows, key support and resistance levels at the extremes, you will notice some of them form PKCs at the extremes. But the pattern can happen anywhere, but always gives the strongest reversals if it is created at the extremes, like raids of swings, highs, and lows. So the higher time frame of the PKC, the stronger the reversal. So for example, if you get a monthly PKC, usually you get a monthly move, and those are usually pretty big. Can occur like a daily or weekly rally. If you get an H1 PKC, then could happen across a couple hours, could happen a couple days. Sometimes if you mix and match PKCs, like a monthly PKC, you see an H1 PKC in the mid-range, then sometimes those are the best ones because you can just limit your risk to the H1 PKC and get the monthly PKC move. So those are pretty good. So just a reminder, once the third candle confirms the direction and the impulse, it almost never goes back to the second candle until some time. So a different entry technique is needed to get in the initial move. So if I'm gonna go through a couple charts, and usually once a PKC confirms, it's usually a strong impulse. So unless you get in on the initial move, the pullback into the PKC can take some time, depending on the time frame of the PKC. I will elaborate on that later. Alright, so just a quick recap of the 3 candles of the PKC, but don't worry, I'm going to go over it with charts, but just a really quick recap. The first candle is the buying or selling candle. It's usually very wicky, and or sweeps highs or lows. Second candle is a neutral candle, does not determine anything. And the third candle is pretty much the impulse move. It's a candle that determines the direction of the reversal and confirms the pattern of the strong impulsive move. Okay, let's get into it. Alright, let's get into some charts. Okay, so this is a weekly chart for Micron Technology. So let's go in with the first candle. First candle of the PKC is usually a buying or selling candle. It's usually very wicky and or sweeps highs or lows. So if you notice here, we have a key resistance here, rejected, sold off, and now we are retesting it again. And the weekly candle just closed as a long wick and pretty much sold off once it swept these highs. So it is closing as a bearish weekly candle. Next candle is neutral candle. So always remember that the second candle for PKC is a neutral candle. It does not determine any direction for the setup. So for this example, it pretty much continued the bearish pressure from the previous week's candle and closed as a down day. Third candle, it completely reverses the previous week down candle and confirms the demand zone for the PKC. As you can see, it is an impulse candle that determines the direction of the reversal and pretty much confirms the pattern of the PKC. So it's pretty strong close. It completely engulfs the previous 2 candles, 1, 2 closed above it, also closed above this weekly resistance zone and the previous size. Next after the third candle, you get the impulsive move. So this is very important because sometimes you get a 3-bar pattern without an impulse and it pretty much just becomes a false breakout. So this is a very important aspect of the PKC. You need to see momentum after the third impulsive move. So 1, 2, 3. Next, you get the impulse move. All right. So how do we mark up the PKC demand zone? Basically, the PKC demand zone is pretty much the second candle. So you outline a range for the second candle with top of the range, the mid range, and the bottom of the range. So you can enter at the top of the range, or you can enter in the mid range. Your stop goes under the PKC low, or you can put some space under the PKC low and put your stop under it. The take profit targets is always a measured move of 1 to 3 times off the demand zone. So if you measure this is your demand zone. Profit targets is always a measured move of 1 to 3 times of that. So for this one, measured move, everything is the same. So for here, stop entry, stop goes under the zone for 2 to 3R. Mid-range entry, stop under the zone. Problem with entering the mid-range, sometimes price doesn't get to the mid-range, so you risk the trade of not getting triggered. For this one, you enter the top of the PKC, giving some space under the zone for raid. You give up less R, but it's also safer, just in case price decides to raid the low. Mid-range entry with stop with space under the zone. You risk the trade not getting triggered, but it's also safer just in case of a raid. Next, price goes back into it. Pretty much tags the mid-range. So if you entered here in this setup, you net 3R. This setup, you net 2R. This setup, you net 7R. This one, 3R. If you notice, there was a pretty good trade. So it just depends on what your risk tolerance is. You can enter at the top, you can enter in the mid-range, and just depends on where you want to put your stop loss, and that determines what your profit targets are. Alright, now we have a daily chart. So now we mark up first the key support and resistance zone. This is the key support resistance zone. Rejected, pushed up, support, push up. Now we are retesting it for the nth time. Buying candle, very wicky, closed as a bullish pin bar, and swept this low. Second candle here is a neutral candle, closed as an inside bar, pretty much contained within the range of the first one. Just remember, the second candle is always a neutral candle. It does not determine any sort of directional bias. Third candle, the candle that determines the direction of the reversal and confirms the pattern of the strong impulsive move. So we have the first candle, which is the buying candle. Second candle is neutral. Third candle is pretty much the impulsive move and confirms the PKC. As you can see, pretty much rallied all the way, closing way above this high, and confirms a market structure break. Alright, so how do we enter the PKC? Just same as last chart, you mark up the range of the second candle, and you can enter at the top, or you can enter in the mid-range, stop under the PKC low, or give some space and stop under that. So Take profit targets is always measured move of 1 to 3 times of size of the demand zone. So you measure the second candle and count 1 to 3 times size of that. Just take it from me, just for the sake of this setup, 1 to 3 R is usually a good bet, but I've seen it go to a lot of R. So I do highly suggest that you leave some on the table or leave some runners. I'll show you in a minute. There. So price dipped and tagged the mid-range, netting 3R. This one tagged the top, enter at the top, net 3R. If you entered in mid-range, stop on the low, 6.5R. This one is 1.77R, and this one is 3R. It was a pretty quick trade. If you mark this up on your chart as USDJPY, it was pretty much the bottom for quite a while. I pretty much rallied like 1,000 pips after this. So it was a pretty good trade. So I do suggest leaving runners. Now we have an H4 candle. Okay, so first things first, you mark up the key resistance. This was key resistance, reject, 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 reject. Try to push up, then get rejected. Then candle, rejected again, rejected again. Closed as a bearish pin bar, very wicky, and swept this high. So remember, the first candle is buying or a selling candle, usually very wicky, and sweeps highs or lows. So this matches all the requirements. Second candle. Second candle is always neutral. This goes as a down candle, even it goes as a wick too, but always remember second candle is the neutral candle. Third candle is the impulse candle. Third candle is this one, confirming the PKC. So it pretty much broke up above the key resistance in red and showed an impulsive move here. After the impulse, you get 1, 2, 3 more H4 green candles, so that confirms the impulse. Next, how do you mark up the PKC? Same as last time. You mark up the range of the second candle. You can enter at the top. You can enter the mid-range. Your stop losses can vary depending on your risk tolerance. Stop under the low or give some space under the low. As you can see, price never reached the mid-range. So it tagged you at the top. If you enter the top, net you 3R. This was a slightly larger stop, probably around 2.5R. If you tried to enter in the mid-range, you never got tagged. So that is the risk of entering in the mid-range. So depending on what your goals are you okay with less profit but you get a short tag, but are you okay with more profit and run the risk of not getting tagged in the trade? Alright, so let's get into an H1 PKC chart. So this is one of my favorites because around this time I just started trading futures and this made me a lot of money, so I remember this trade. So let's get into it. So we have a key support here. Price pushed up, rallied back into it, pushed up again, dump pushed up, then big dump fest and closed under it, got everyone bearish. We got a PKC. We have the first candle here, second candle, and third candle with an impulse. So as you can see from the third candle, it pretty much impulsed above the key support level here. Now you say same as last time, you mark up the second candle as the demand zone, enter at the top, enter at the mid-range, and stops varies depending on how you want it. As you can see, price tagged the mid-range pretty comfortably, went to 3R pretty quick. I think this happened like the next day, so it's a pretty good trade. Now we have a daily chart for S&P 500 for ES. So this is the perfect PKC, selling candle, second candle, then impulse candle. And the mid-range is also perfect because it's also retesting and confluent with these prior highs. So when this set up, you're like, okay, this is a pretty good trade. Now let's see what happens. It stopped out. Now, why did it stop out? It's because after the third candle, you didn't get an impulsive move. That was the first warning shot. First warning that the PKC will not work was no continuation candle off the third candle impulse. Second warning was this selling candle. So if you still wanted to take the trade, you could, it still reacted a little off it, but pretty much continued to the downside. So the key requirement, remember, of the PKC is you always need an impulsive move away from the third candle to confirm the move. Alright, last example. We have the SPY daily time frame. So it's kind of tricky to spot a PKC with stocks because of the gaps in price. So you pretty much have to look at it candle by candle and pretty much just dive into it. So we just mark up the key support here, mark up the green, price pushed up, sold off. Next day, price pushed up it again, sold off, price supported it, sold off, then price decided to close back into it. The next day, pretty much put in a buying candle, long wick, and closed above the key support. Second candle, always remember, second candle is a neutral candle. So pushed up, price opened below, but pretty much closed with sort of a buying candle. But always remember, second candle is a neutral candle, but it's still closing at support. Third candle confirms the PKC pretty much impulsed away from the support zone, closed above the previous 2 days highs, and had a fourth impulse and closed above the side for a market structure break. So that confirms the PKC. And now we mark up our demand zone. As previous examples, we mark up the second candle's range. You enter at the top, enter at the mid-range. Stop losses vary depending on your risk tolerance. And your profit targets is always 1 to 3R off the size of the demand zone. As you can see, next, I think it tagged after a couple days. It was a pretty good trade. It went to target the same day, so it was a good one. Alright, so we just went over a lot of examples of the PKC across multiple time frames, and I'm very confident about the strategy because I traded a lot, and I'm also very confident about it that I'm able to post this on my Twitter and pretty much make calls about direction for swings, for reversals. So as you can see, I posted this on October. I said if this gives a hard close under Monday low, possibly confirms a bearish daily PKC, and can put in a short-term top and support this equity rally. So you can see pretty much we had a 3-bar pattern here, selling candle, neutral candle, impulse candle. As you can see, we have an impulse here. Price pretty much traded into it. Couldn't even just tagged you in the mid-range and pretty much collapsed from it. So it was a pretty good PKC, and the ability for you to call out a reversal ahead of time is a powerful thing. So you can pretty much just set alerts, just wait for the alerts to trigger, and take your trades from there. Next one, I made this call on October 23. Load up on Microsoft weekly PKC demand which is also confluent with the 200 weekly moving average. So remember what I said, that weekly demand zones, PKC zones are very effective once you have, if you have key levels at that area. So now for this example, I had the weekly 200 moving average, confluent mid-range with the weekly demand zone, weekly PKC. You had the first candle, buying candle, neutral candle, then you have the impulse away. And I made this call on October 23. Pretty much gave a 20% move. I made some money over here. Bought some calls, and it was a good move. Alright, so that was a pretty long video. It actually doesn't take a lot of time to spot the PKC, but for this video it took a lot of time just to note up the charts and look up examples and screenshots and everything, put it into a presentation. So I will continue this next time for maybe part 2 and part 3, because there's a lot more to cover. So for part 2 video will be about the PKC2 and failed PKCs. Those are two different strategies, and it's equally effective as well for reversals. Gives the same, probably gives the same amount of reversals as well. Part 3 video will be lower time frame entries with higher time frame PKCs. This is one of my favorites because you can get into a 3-month or monthly PKC or daily PKC, and you can zoom in lower time frames like H1, M15, M5, and enter through there with less risk and more profit. So it requires a little bit more timing, a little more advanced techniques, and it's going to take a lot more time to make that video. So if this was helpful to you, please like and leave a comment if this video was helpful to you in any way. I will try making part 2 and 3 faster if people find it helpful. So if people like this video, if it's just a couple people, then I'll take my time. But if it's a lot of people that want me to make the part 2 and 3, then I'll definitely make it faster. So good luck with everything, and I hope you like this video. Please like and leave a comment, and good luck trading.